This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, Certified Financial Planner and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go in our Knowledge Center, which gives you a direct link to YouTube, where we've had well over 1 million views, multiple videos that help answer the questions that you have. And if you want to put an inquiry so we can talk about it on the show or create a Knowledge Center video, please send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And also you can go get this episode, any one of our previous episodes on Spotify, podcasts, you name it, folks. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks. And we talk about all important topics of personal finance. That's where you are today, how retirement looks like, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we can help you with. And we are offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. And we have offices all across the country that we can help you with. Folks, give us a buzz. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer those questions that you have to help with your financial situation.
Lots to talk about on today's show, folks. I wanted to go over some of the recent postings that I've had on social media and some of the great traction that we've had. I thought, hey, how come I don't go over those postings, which are the top 3 ways rich invest, 6 ways successful for success during market volatility, and so on. There's just like 6 or 7 of them. I'm going to try to go through them all, and I can always have a continuation episode on this. But I wanted to go over some of these and talk about them in more detail because I can see with some of the comments people are asking about them, and I get it. Some of these things are really good, but I didn't want it to be a teaser. I wanted it to be some good context for you to take advantage of. So I thought, why not talk about it on today's show? So that is what we're going to be talking about today, folks. And so I wanted to first start off, and this was an interesting one, with the top 3 ways rich people invest. And I hate to say it like that, but you know what? Rich people get richer for a reason. And so there are 2 sides to this, literally how they invest, and then just the strategy side of it as well. So I'm going to go through these, and now I'm going to list them. So one of them is the top 3 ways the rich invest. The second one is 6 steps for success during volatile markets. Then is afraid to miss the market rally. Here are 3 things you can do now. 4 strategies for market shocks. Top 5 regrets retirees make, and then are you ready for your midlife checkup? Okay, so these are 1, 2, 3, 4, 5, 6. I'm going to try to pound these out today. We're going to go 3 in each segment. Let's start off with the top 3 ways rich people invest. And the first one is, and here's the interesting part, the alternative investment aspect to how they invest. They are interested in, number 1, the exclusivity of that investment. Okay, they're just into it. They want things other people can't have. They want to feel special. I get it, but does it work? Now, here's the thing. When you look at the stock market, how many stocks are in the NASDAQ and the New York Stock Exchange? Maybe NASDAQ's a bad example. The New York Stock Exchange, how many stocks that are listed versus how many were in the past? There is thousands of discrepancy where we had more in the past than we've had today. Why? Because you have people going to private equity investors instead of going to public markets. They don't want to have to deal with the SEC. They don't want to have to deal with a lot of things. So they partner with private equity investors to help funnel that growth and the money that they need to grow. And so you actually see that private markets, because it's illiquid and longer term investments, do have higher expected rate of return than public markets. Now, certain private markets, they even want to take it public as well. Now, it is more risky. That's the issue with these. They can be more risky. And it's not only on the stock front, on the private front as well, for bonds as well. They call it private debt. These are yielding higher than normal bonds. Yet again, there's illiquidity piece. And the thing about rich people is when they put money away, there's a reason they want you to have at least $1 million, and for an accredited investor, and then for another type of investor, forgot the name of that, they want you to have another $5 million available. So they want that, and that's liquid. So they know that they could put $100,000, $500,000, $1 million and not worry about it, not need to bug anybody for liquid reasons. So not just on the public side, but on the private side, investments which are considered alternative investing, not just stocks, but bonds as well. Number two, the way rich people invest is they are disciplined. They do not freak out at all. What are they doing throughout this time frame? They are, in fact, buying more. When markets drop, they don't freak out. They understand this is all part of the plan, and they look to deploy more capital into their investments. The last thing that rich people do and how they invest is they delegate. They like and value time, these people. And investing takes time. When they have a law problem, they don't try to fix the issue themselves. A legal issue, they get an attorney. They have a tax problem. Do you think they're doing their taxes through TurboTax to save a few bucks? No, they have a few bucks. So what do? They hire a tax professional. And then, of course, on the investing side, they have an advisor. They're not wasting their time doing it themselves, researching it, managing it. Markets move. They're not making those movements. They're delegating out that responsibility. These are crucial pieces of how rich people invest. You look at other rich people, you see what they do. They value their time. They want to do what they want to do, not what they have to do. They try to work as hard as they can possible so they can put themselves in a situation where they only do what they want. And there's two types of rich people. You have the shrewd, the mean, the aggressive. Some envision like a Donald Trump. I always get my way and this is what I do. Keep in mind, he's still working. And then you have the other rich people that are so easygoing, always smiling, always happy, always polite. Sure, they can always get their way, but they're doing it in a different manner. So, two different sides to how that's going. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host to More Knowledge, More Wealth here on every weekend, and we're talking about all important topics of personal finance. And today we're just talking about some of the social media posts that we've had and some of the success that we found from it. And I wanted to go over, first off, the top 3 ways the rich get richer, or how the rich invest. The second part is 6 steps for success during volatile markets. The first one is, please keep your perspective. Like, seriously, it's long-term investing. You have your money in a retirement account, an IRA, and let's say you're 55 years old. Let's say you're 35 years old. Are you really going to try to go to all cash? Like, you can't just get it right once. You have to get it right twice. The markets have yielded over 10% returns by riding the wave. And the mistake that you can make for trying to time the markets can be so crucial. When you look at the average return of an individual investor, a retail investor we call it, their average rate of return is 4% versus the market return of 10%. They significantly underperform because they think they're smart. Keep your perspective. It's in a retirement account, even in a brokerage account. If it's earmarked long-term for retirement, let it ride. Let it go. Don't go all cash. I'm not trying to say don't do nothing when I say let it ride. You have to be strategic and you have to be proactive. This is why how you invest is very important. The second thing during market volatility is take a look at your current plan. For example, your 401k plan, you may want to say, instead of trying to stretch it out throughout the whole year, maybe for the next 2 to 3 month period, instead of saving 5%, save 10, 15%. But then at the back end of the year, you can't have it at 10 because you're going to max it out too early. And if you max it out too early, you don't get the employer match. So you might have to move it to 5 or whatever it may be. But you could take advantage of volatility and buy in while markets are down. Number 3, focus on time in the market, not trying to time the market. As we've said before, and I kind of hit it a little bit on keeping your perspective, you need to stay invested long term. Time in the market, you will get the yields that you need. You don't need 20 to 30%. I know people are like, I saw this before, invest in the S&P 500, invest in stocks, you'll retire in 30 years. Invest in Bitcoin, you'll retire in 10 years. Invest in NFTs, you'll retire in a year. It's like, these people are idiots. How did that work out for you? Look at what NFTs, it absolutely crashed. Stop focusing on the next rocket ship. How about you focus on the destination? So, number 4, invest consistently, right? Just if you're investing, keep investing. You're investing $100 a month, $1,000 a month, $10,000 a month, $100,000 a month. I don't care what you're doing. Consistently do it. Because market volatility, that's where you have dollar cost averaging, where your average cost per share is lower than the average price per share. Number 5, get help, especially when markets are down. Like seriously, if you're freaking out, this is where you need to realize this is what you're investing in. You have to take a look. Is all your investments all in one asset class? Should you be diversifying that out into other asset classes? If you already have other asset classes, are you able to start to sell certain investments and buy other investments? Sell what maybe hasn't lost money or hasn't lost as much and buy what's really lost, assuming it's a proper allocation and asset class that will perform well for you long term. You get what I'm saying? Like, there are things that you maybe should be doing. There are strategies that you could be taking advantage of, such as maybe do an RMD of stock versus cash and putting it in your bank account. Let the rebound happen outside of your retirement account. Doing a Roth conversion during that period. Doing tax loss harvesting. There are things that can help you that you'll never see on your investment portfolio statement, but it'll help you in overall what I call tax alpha. Your overall after-tax return will be more. I don't care about your $1 million in a retirement account. I care about the purchasing power of that $1 million. I would rather have $900,000 in a Roth than your $1 million in a taxable brokerage. So taking a look at a perspective of your overall portfolio is huge in the overall success. Number 6, the last one, is if you can't do it on your own, look for a professional. How convenient for me to say that, right? But it's true. And this is why we're offering a free financial assessment where we'll give you 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short. I see it time and time again, folks. You have great ideas. You hear great ideas. You want to execute them, but you're busy. Work is busy. Everybody's busy. Family's busy. Personal life is busy. We're in a society where everything is just busy. So please, if you're not going to do it, hire somebody who can. That's why people have personal trainers. That's why people have nutritionists or chefs. Why? Because you know you need to eat better. You know you need to work out. You know you need to get up. But sometimes having somebody holding you accountable and helping you do it will help you achieve your goal. And with money, ain't that the most important goal possible? I think so. Folks, we're going to go on a quick break, and when we come back, we're going to talk about more of some of the other social media topics that I've been posting about that you've been asking for me to go in more detail on in just a few words.
This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business. Talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions. And also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short, and fill out the form fill right there on our site. We would love to help you in your financial situation. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And today we were just talking about some of the social media posts that I've done, and I've gotten some really good feedback with people saying, I want to learn more. Please tell me more. So I'm going over the past month of some items and topics that I went over. The first segment, I went over the top 3 ways of how the rich invest. And then the second one was 6 steps for success during market volatility. So now on the second segment, I'm going to go ahead and talk about afraid to miss the market rally. Here are 3 things that you can do now. The first one is dollar cost averaging. Who said you had to do everything all at one time? So you can, if you had $1 million you're looking to deploy, why don't you do $500,000 over the next 2 months? Or how about you do $250,000 every month? How about you do $100,000 every month? You get what I'm saying? You don't want to drag it out too long because you might still be building up more money for you to invest, but these are something that you can do. Other item is, if you're scared about a market rally, well, what is your definition of a market rally? Well, that could be the S&P 500 or the NASDAQ or whatever going high. Well, there could be international, mid-caps, small caps. So by diversifying out your money, it is a crucial way for you to be able to put your money in a situation where you can be successful. Keyword, you can be successful in taking advantage of other markets that maybe are not in a rally. Markets perform well, and diversification is necessary because you can have turmoil. There will most likely be a long period of time where the S&P 500 has gone stagnant for 5 years and 10 years. We just haven't experienced that in a while. That's my opinion because of the returns have been so fruitful over so long. In my opinion, just as just an opinion, this isn't even a professional opinion, but it's a thought. I look at emerging markets and see how it performed in the 90s. It absolutely boomed. And you see how it's been done in the past 10 years, the performance of that, it's been very poor. Why do I bring that up? Because it just can't be sustainable where an asset class gets a 20% rate of return consistently. Everything seems to be within that 10% range. And so for that reason, sole reason alone is why I think you should be looking at diversifying your investments because the large cap has been very, very well. The third one is how just afraid to miss the market volatility. I would just say, just go ahead and invest. Like seriously, just pull the trigger because 7 out of 8 times you're going to be happy that you just invested your money as soon as possible. So for that reason alone, if you're not going to need the money in 5, 10, 20 years from now, just invest it. Who cares about trying to time it? It's better to have your money in the market versus trying to time the market. That is the first piece there. So we're going to go next one into the 4 key strategies for market shock. What's a market shock? When the market gets punched in the face. So it's almost the exact opposite of a market rally. Number one thing that you should do is diversify your portfolio. Pretty simple, right? Because what you're seeing is on the TV talking about the S&P 500, Dow Jones, and NASDAQ. Well, that's just large cap USA. What about mid caps, small caps, international, emerging markets, developed markets? You know what I mean? You still got potentially fixed income in your portfolio. So by diversifying your portfolio, these are great strategies for when the market drops. I think our team here said market shocks. Sounds different, I guess, but for market drops is what I'm going to start saying. Here we go. Piggyback off, diversify your portfolio. Include mid caps and small caps, not just large caps in your portfolio. Did you know, just from an academic point of view, and history shows this, has proven this, the evidence shows that mid-caps and small-cap companies outperform large-cap companies over periods of time. It's simple. It's quite logical for it to do that. It's a lot easier for them to double in size than a company that's worth $1 trillion to double in size. It's all based on the future expected growth and cash flows of the company. Small caps and mid-caps, it's a lot easier for them to do that. Third one is invest in international. These are strategies to do because, yet again, you're just focusing on large U.S. companies. International companies right now are on sale. It could be a fantastic time to invest in them. So when you're worried about markets dropping, these could be markets are going up international. They don't have a one-to-one correlation. Some of them have negative correlation, and this is something you have to build in your portfolio. The final thing during market shocks, market drops, is looking into alternative investments. They're not subject to public markets. They're not subject to people freaking out and selling on sale. Private markets are more illiquid, but they give you more consistent returns and can give you higher expected rate of returns in the investments. This could be on the equity side and definitely on the fixed income side. Those are fantastic options for, yet again, people that are looking to put their money to work while the markets are dropping. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. Today, we're just talking about some of my recent social media posts, and we are going over what this means for you. And you wanted to know and have me go in more detail, so here are this past month's more details that I've been going over. The next one, and this is my favorite. Should I leave it last? Now, just go ahead and do it. The next one is the top 5 regrets retirees make. I absolutely love this one. And so this, let's go ahead and go with it. The first one, just go straight to it, is taking Social Security too early. Did you know over 50% of people take Social Security at 62? But Social Security grows at 8%. It's tax-free on the majority of the states on the personal or on the state side. And on the IRS side, the federal side, it could be 15% tax-free, 50% tax-free, or 100% tax-free. So unless you're getting an 8% growth somewhere else, guaranteed, I would recommend waiting as long as you can. Now, you got to see if that makes sense, depending on your portfolio, your taxes, and so on, and strategies that may be available to you. But the biggest regrets people make is because they think they're only going to live until 70 or 75 or 80. Well, now they're in their 90s wishing they would have had more money. Number 2, there's people have too much in their IRA account. Think about that. That is some of the biggest regrets that they have. Now, they have all this money in there, and their RMDs, which used to be 70.5 required minimum distributions, then they moved it to 72. Now it's 73, and it will eventually be 75 for some of the younger listeners out here. You're going to be forced to take money out of this. What people don't realize, if you have $500,000 today and you're still working, in 10 years from now, assuming you max contributions, it could be very well close to $2 million at 65 years old. And now, if you're not touching that money because you're using savings or social or whatever the case is, well, that $2 million could easily be $4 million by 75. And then all of a sudden, now you have a required minimum distribution of 4%. That's $160,000 forced withdrawal. They find out later that they save too much, and that's where they should be diversifying their money, especially in those low tax years, by taking advantage of a Roth IRA or doing Roth conversions. Number 5, here's a kind of a big regret. This is kind of more personal side of personal finance, but that is they worked longer than they needed. They were too conservative, and they realized they're not going to outlive their money. And God bless these types of people, but they worked a little bit too long, and they just wish they would have retired a little earlier. Now their kids are maybe married, maybe they moved, maybe they have grandkids, and they just didn't do the things that they wanted to do. God forbid they're not as healthy as they were. These are items that they often look at and just have regrets. I worked longer than I needed to. Especially those that don't love their job. If you love their job, then I get it. But if you don't mind not working, think about that for a second. And by the way, typically people that are rich love what they do. It's hard to have a lot of money when you don't love what you do. Because if you don't love what you do, you're not motivated, which means you don't perform well at your job, which means you're not making excess money through bonus, through promotions, and so on. So please, 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 I'm almost squeezing in my own biases here. Find something that you love. Number 4, they tried time in the market and absolutely got plummeted. They got failed. They got punched in the face. So trying to time the market sounds good, makes sense. Hey, you got the elections coming up, or happened, or political season, or whatever the case is. Yeah, it's very easy not to pull your money out or anything like that. Stay disciplined in what you do. Number 5, biggest mistakes. This I hear more than all of those 4 combined, is they should have hired a financial professional sooner. I hear that all the time. I wish I met you 5 years ago. Because people just don't think they need help. They don't know what they don't know. And this is the biggest mistake I see people make. They're like, wow, I've been enjoying these low tax years forever, or I took Social Security too early, or I had a business that I wanted to talk to you closer I get to retirement, and now restructuring your business saved you 10, 15, 50 million, or 50 million, $50,000 in annual taxes. Just like things like that, people just wish they met with us sooner. So those are the top 5 regrets retirees make, and the things that you should be reanalyzing on yourself. There's so many things that you just don't know about that you're trying to do it on your own. Heck, you're trying to figure out your job. You're trying to figure out your marriage. You're trying to figure out your kids. You're trying to figure out your social situation. There's so many different things, and you're trying to add a complexity that there's a whole profession, which, oh, by the way, some of the richest, most powerful, most successful people in the world have outsourced this, and you're thinking, what? Maybe you don't have enough? I don't know. I really don't know. Would love for you to drop us a line and tell us what you're thinking of why you do not want to hire a professional. You think it's expensive? Think it's expensive? Try doing it yourself as an amateur. You'll see what expensive is. The last one I'm going to go over is, are you ready for a midlife checkup? Here are 5 things there. Number 1, look at your asset classes. Do you see a consistency here? Make sure that you are properly diversified. Make sure you're not all just in large cap USA. Number 2, be prepared for market volatility. It's going to happen. Know it's going to happen. You're not timing it, but you want to be proactive, which means if you make a whole bunch of money in one asset class, take that profit and redistribute it into other asset classes, because they do not all move in the same way. Number 3 is rebalance your portfolio. Hence, kind of preparing for market volatility. Rebalancing your portfolio before market volatility, when you make money, is called being proactive, versus when the markets drop, that's reactive. But still, rebalancing your portfolio is huge. Reassess your short-term investments, especially in money market and bond rates, are where they are now. They're going to go down. Interest rates are going down, so this is the perfect time to start reanalyzing that. If you're enjoying a 4 and 5% money market, you're not going to be enjoying that for long. This could be a fantastic time to get into intermediate term bonds, because as interest rates drop, those improve and go up in value. Last one, real estate investments are looking a little bit more promising, especially as interest rates going down. That means your mortgage payments are less, and that means from a cap rate point of view, you will get a higher cap rate return. So this is a time just to relook at it. I still have some YouTube videos out there that tells you what's a good real estate investment. There are certain returns and percentages that you should be looking at.
That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. I want you to have a fantastic weekend. Have a great week, and God bless.